The topic today on tax loss harvesting is a little complex and detailed, but Matt has done a good job of boiling everything down to the key points. We did want to cover this topic for a couple of reasons. One is that we want to give you a variety of topics that are interesting about financial planning and investment management that we think clients should know a little bit about. We know that many of you want to get into some of the details and are interested in the what's going on behind the curtain sometimes. But we also want to stress that this is just a bit of understanding about some of the work that we do on your behalf in your portfolio, but you don't always have to understand all of the details or feel like you could do this work yourself. So with that, I'm going to turn this over to Matt Hilland. And again, if you have any questions, feel free to add them to the chat box, and we will pause at the end too for your verbal questions. Thanks. Take it away, Matt.
All right, thank you. And thanks for joining us again on your Friday afternoon. These last few weeks, we've wanted to do webinar topics that are relatable to events that are happening today with the coronavirus and the subsequent stock market volatility. And today's another topic on that list. It's something that by and large we haven't had to think about for a lot of the last 10 years, since it requires your investments to decline in value somewhat significantly. And no one ever roots for their investments to go down in value, but of course it's inevitable to happen sometime if you're an investor over, decade-long periods. And this is one way that you can take advantage of times like we've seen today to strategically give you some tax breaks and provide a silver lining to any temporary stock market declines. As Quinn said, some of this is a little bit technical, and if we manage your investments for you, we kind of handle this for you. You don't have to worry so much about identifying the right times to do it or exactly how to execute it. But we think it's important for you to know what we're doing and knowing why we did what we did when we send you an email saying that we're performing tax loss harvesting for you. And also just to point out some of the value in our service that kind of happens behind the scenes sometimes. We're going to start with a quick overview of what tax loss harvesting is, and then move on to some planning strategies around tax loss harvesting, and even sometimes when it would be a mistake to do so. To start, just to make sure we're on the same page, what do we mean by tax loss harvesting? Tax loss harvesting is purposely selling investments that have gone down in value to recognize a loss. There's kind of a common saying for investors that it's not a loss until you sell. And this is exactly what we're doing. We're deliberately trying to recognize a loss. And just as a simple example, let's say you buy 100 shares of Microsoft at $100 per share. It's a total of $10,000 invested. That $10,000 is your original cost, or what the IRS calls your cost basis. But let's say you made that purchase in January of 2020, and 2 months later now the stock market's dropped to $70 a share. Now your $10,000 original investment is worth just $7,000. And if you were to sell right now, you would have a $3,000 loss. It's important to note that this loss is credited just for taxable brokerage accounts. This is your Schwab One brokerage account, a designated beneficiary account, or trust accounts if you have your investments with us. This does not apply to IRAs, 401ks, and Roth IRAs. So at this point, if we would think tax loss harvesting is beneficial for you, we might advise you to sell this investment and recognize a $3,000 loss. Selling when your investments fall in value is a little different advice than what many of you might have heard us say in the past. You've probably heard Eric or Quinn or I talk about ignoring volatility in the stock market and not getting worked up about times the stock market goes down and being a long-term investor. So what's the difference between that advice of saying buy and hold compared to here us maybe telling you to sell this falling stock? The difference is that there are certain benefits for recognizing a certain amount of loss at specific times. The most important benefit is the tax deduction. By taking that loss, that $3,000 loss in the example before, you can take a deduction on your income for the year. And it's a very important deduction called a top line or above the line deduction. This lowers your AGI, or adjusted gross income. You can look for yourself how this has played out in the past on line 6 of 1040 of your tax return. That's kind of shown here. And this is important because your AGI, or adjusted gross income, is benchmarked to many other benefits, whether or not you're eligible for a Roth IRA, how your Social Security is taxed, how much you pay for Medicare. And on our webinar last week, we talked about the stimulus checks, which were sent out based on your AGI. So your AGI determines a lot. And so this is an important tax deduction for you to take advantage of, but of course it's not limitless. You're capped at taking just $3,000 deduction each year. So even if you sell something that's gone down $20,000 in value, you can't take a $20,000 deduction in a single year, just for example. And while the deduction you can take is capped at $3,000, you can offset any amount of gains. So for example, if you need to raise money to buy a car or maybe make a down payment on a house, and you sell $40,000 of US stock holdings from your brokerage account, you might recognize, or you will recognize, gains if they have gone up in value since you purchased them. The price you originally paid for your investment, remember, is called the cost basis. Shown here is just an example. Maybe you originally purchased $30,000 of US stocks that have now gone up in value to $40,000 today. Normally, these gains, $10,000 in this case, would be taxed as capital gains, which for most are taxed at 15%. So that would mean a $1,500 tax bill for you. But over that same time, maybe international stocks have not done as well, like we've seen recently. So maybe you can sell a portion of your international stocks, which have lost $10,000 in value, and you could completely wipe out the gains that you would have been taxed on and eliminate that $1,500 tax bill that you had if you had just sold those US stocks before. You can recognize any amount of losses you want during the year, and any amount of losses can be used to offset gains that you've recognized. So if you have a $1 million gain on one stock and a $1 million loss on the other, they can cancel each other out. But you can only take excess losses over your gains of $3,000 per year. So that's kind of the difference here between canceling out other gains compared to taking the deduction. The deduction is limited to $3,000. However, you can recognize large losses that are greater than $3,000, and of course that does sometimes happen. It does not go to waste. The benefit just gets spread out over multiple years. As we said, the most you can use in any single year is $3,000, but what happens if you realize a larger amount, say $10,000 loss? Below we show a similar situation as the previous slide, but now there's $20,000 in losses from this investor's international holdings. So in total, they would recognize a $10,000 loss if they sold these US stocks for a gain and then also sold the international stocks for a loss. If they recognize no other gains for the year from their investments, they could use $3,000 of this $10,000 net loss towards a deduction for this year. And then they can carry forward the rest of the losses for future years. The most you can use in any single year is $3,000. So if they recognized a $10,000 loss, they could use $3,000 each year for the next few years. And then, in this case, the remainder in 2023, just to use up that full $10,000. This requires an extra tax filing to notify the IRS of kind of this bank of losses that you have, and also keep track of that balance over time. But any tax preparer will be familiar with this, and even TurboTax will help you do this if you like doing taxes yourself. And so that was a quick rundown on how these deductions can be captured. But now we want to highlight the planning strategies that are available from this. Tax loss harvesting creates opportunities because it lowers your AGI, or adjusted gross income, and a lot of different tax benefits, credits, and deductions are all based on your AGI. We're going to take a look at a specific example on the next slide, but I just wanted to give you a look at some of the benefits available to you and your eligibility of those based on your AGI. We've made the pitch over the last couple webinars that we find a lot of value in tax planning for clients. And if we don't have a copy of your latest tax return, get in touch with us to share a copy with us, because it really helps us out when finding these opportunities for you. This is a screenshot of a tax report that's put out by some really neat software we've added recently to our toolbox here at Arnold and Mote. And we can input the numbers from your tax return and very quickly spit out a report identifying a whole host of tax credits, deductions, and brackets, and other tax breaks that you could qualify for, or maybe more importantly, that you're on the verge of qualifying for if we could lower your AGI just a little bit. With this report, we can quickly find opportunities where that $3,000 tax deduction could really help you. And just to give you one specific potential example for these tax loss harvesting deductions, we'll look at an example for someone on Medicare. Everyone in America over 65 is eligible for Medicare, and Medicare Part B is the basic coverage that everyone should get. Everyone pays the same minimum monthly amount for Medicare Part B, and your premium is increased if your income, measured by what's called the MAGI, or modified adjusted gross income, which is just that same AGI we talked about earlier, but with a few other items. And your Medicare premium is based on that. And this chart here shows the change or the increase in your Medicare premium based on your income. There are many more tiers to this chart. Just for simplicity, I'm just showing you the first couple tiers here, but this is one of the very few hard cutoffs in the tax code. A lot of benefits, kind of slowly phase out based on your income, but this is one example where a difference of just $1,000 can make a relatively big difference in your Medicare premiums. And you can probably see where I'm going with this example. That means there's a huge opportunity for anyone within kind of $3,000 of this line in the sand. If you're around $87,000 to $90,000 in income, taking deductions could dramatically, lower your Medicare premium. And so, just for example, a person today who is on Medicare may have pension, their Social Security, required minimum distributions from their IRA or 401k, plus maybe interest and dividends for their investments. And let's just say, for example, that total is $89,000 for the year. That $89,000 in income means they'll pay $202 a month for their Medicare Part B. But a year like the one we're having today might give them a good opportunity to lock in enough losses to take a $3,000 tax deduction from tax loss harvesting, and maybe even recognize more losses to carry forwards those losses over future years. And so, thinking about our example on the previous slide, if this investor could capture $10,000 in losses today, they could lower their modified adjusted gross income $3,000 a year for the next 3 years. This can bump them back into the lower tier for their Medicare premium, save them $58 a month over the next 3 years, and that would save them $2,100 over that 3-year time frame. Now, obviously, this is a little bit of a specialized scenario, just one of many different scenarios. Not everyone is on Medicare, not everyone is within $3,000 from this income level. But as we saw in the last slide, maybe it's not Medicare for you, but a $3,000 tax deduction could be keeping you eligible for Roth IRA contributions. If not Roth IRA, maybe keeping your income low enough to take a deduction for your child's tuition expenses. Or maybe if you have student loans, it could keep the student loan interest deduction available for you. There's a lot of possibilities here, and we can't make an example for every situation today, but we wanted to show you how This market decline has given a lot of people opportunities to qualify for tax deductions and benefits that they might not have been able to have before. The other main point we want to get across on this webinar is that tax loss harvesting is not just some magic $3,000 that you can capture with no trade-offs. There is some long-term thinking and planning that needs to be done before you execute on a tax loss harvesting strategy. Because really, tax loss harvesting is more of a tax deferral than just a free $3,000 deduction. To illustrate this, consider just a real basic example of someone who buys a stock at $50 a share and sells it for $100 per share later. They will pay capital gains taxes on that $50 gain. Pretty simple and straightforward. But let's say during that time, the stock drops to $25 and they sell it to capture that loss and get the deduction. Now your new cost basis for this investment is $25, assuming you rebuy this investment. So when it goes up to $100, now you have a $75 gain to pay taxes on. If your tax rate was constant through your life, this tax loss harvest doesn't have a lot of use here. You sort of borrowed from the future to get a deduction today, but you would pay it back later in the form of higher taxes on that $75 at a future date. And maybe now you can start to think of a couple scenarios where harvesting this loss could be a bad idea. If you're currently in a very low tax year, that $25 deduction in this case might not be that valuable, especially if that $75 in taxes would be taxed at a higher rate in the future. So an example here could be, a young saver who's just getting started in their career, for example, who might be in a lower tax bracket than they will be for most of their career. They probably don't want to make this trade-off for higher taxes later if their incomes will be significantly higher in future years. Or another example might be a recent retiree who's not yet begun Social Security or their RMDs. They might be in a very low tax rate now, but in the future, once RMDs and Social Security kick in, they might have much more income and therefore be taxed at a higher rate. But then, of course, on the flip side, you can think of some scenarios where tax loss harvesting does make sense. Maybe a doctor or a senior engineer who's at their peak earnings, later in their career, right before they retire. They could take this deduction now, and it would be a very valuable deduction since their income's high. And in exchange for more gains later, but they'd be taxed at a very low rate, if their other sources of income are not there when they retire. So like a lot of topics we talk about, there's no one size fits all. This will be very applicable to some while potentially being, even a bad idea for some others. There are times in your life to take advantage of this and times where it just won't make that much sense. The last example we wanted to cover is an important one for those with taxable brokerage accounts and long-term capital gains. Long-term capital gains are gains you have on investments that you've held for more than 1 year. There's a very important part of the tax code that allows for long-term investments to be taxed at a lower rate than interest or wages or ordinary income. And that's the long-term capital gains tax rate. The government does this to try to incentivize, people investing for long-term periods and not just trying to make a quick buck, on a company. If you're a married couple and your income is below $78,750 for 2020, long-term capital gains are taxed at 0%. And remember, recognizing gains raises your income. So it's not like you can recognize, $1 million at 0%, but if you had no other income at all, you could recognize that 78,000 in gains and pay no taxes at all. So think back to our example earlier about an investor selling investments to raise money for a large purchase. If they sold their US stocks, they'd recognize $10,000 in gains. Previously, they chose to also sell international stocks to offset that gain. That could have made sense if they were in, a high income or a high tax year, but consider now if they fall in this, below $78,000 window. That $10,000 would not have been taxed at all anyway, And this investor would have sold their international stocks to offset this gain and effectively wasted that $10,000 that could have been used in the future, maybe when gains would have been taxable. So it doesn't always make sense to take a deduction through tax loss harvesting, and it doesn't always make sense to offset all your long-term capital gains through tax loss harvesting. And now remember, in order to take advantage of tax loss harvesting, you need an investment that has declined in value from the time you've purchased it. Some people make a mistake in this regard, investing in their taxable accounts and only hold, one investment in that account. A really popular investment today is what's called a target date fund, for example. This is one fund that holds both stocks and bonds. They're designed to be a sort of one-size-fits-all approach to asset allocation. And it's convenient and it's very diversified, but it could really limit how you're able to tax loss harvest because you can't target and make sales towards specific holdings of that fund that have declined in value. All you have the option to do is to sell that one fund. And so all else being equal, you want to hold a diversified set of investments in your taxable brokerage accounts. We've mentioned the benefits of diversification before to many of you and probably shown you an example of an asset allocation just like this, which holds many types of different investments. And every year, different types of investments go up while others go down. This is especially beneficial if you're looking to tax loss harvest because you want assets or investments that are uncorrelated. You want to own investments that behave a little differently to give you more opportunities to have an investment go down in any single year. Some year international stocks will do better than US stocks, others they'll do worse. And by owning these different types of investments and different funds, you're able to take advantage of their volatility. All right, and this is our last slide for the day. I didn't want to go into too much more detail since, again, this is something that for most we manage for you, but because of this rule, your portfolio looks a little different than it normally does when, if we do tax loss harvesting for you. So your portfolio looks a little different in the time periods around when we make these sales. And so we wanted you to know why. This is one more key to tax loss harvesting, and it's complying with what's called the wash sale rules. This is a law set up to ensure you simply do not immediately buy back into the same investment that you sold for a loss. So if you sell Microsoft stock to recognize a loss, you cannot immediately just buy it back the next day. You have to wait at least 30 days after the sale before you can re-enter the investment. And this rule applies to mutual funds and ETFs as well. If you sell a S&P 500 index fund, you cannot rebuy that same fund or another fund that also invests in the S&P 500 index for at least 30 days. So when we tax loss harvest for you, we have to buy a new fund for you that's you're probably not used to seeing in your portfolio. And so for a period of a month or two, you'll see a different fund in your portfolio, and this is why. Because if we were to repurchase that same fund or a very similar fund to the one that we sold in order to recognize the loss, it would cancel out the deduction that we're hoping to get. And that could be potentially bad for you if you were looking forward to that deduction or the offset in gains we were trying to accomplish. And so that was a quick overview of tax loss harvesting. It's a very popular strategy for getting a tax deduction. We wanted to show you a little bit more about the details of the process, but also show you that it's certainly not just a gimme that you should perform whenever it's available. I think if you read a lot of the personal finance writing out there, it kind of puts it out as this no-brainer action you should always perform. And that's certainly not the case. It can be valuable, but you need to make sure it fits your specific situation first.